Hey everybody, welcome back to the Presidio Perspective. I am Dustin Tenbrook.
And my name is Luke Jacobson.
All right, so we have a great show for you here today. We're going to bring in all kinds of colors here. All right, so we got Phill Michelson back on top. We're going to talk about that. We got good news is bad news, cryptocurrency fallout, and then talk about some financial planning here at the end. And this is our 12th episode of the second season, I think, Luke. Yeah, I think we got lucky number 13 is where we might break for the summer. So stay tuned. We're going to have lots of fun stuff this summer. Make sure you subscribe to our YouTube channel so you don't miss out. Follow us on Facebook, like us, and we'll make sure to like you back. All right. So did you catch a little bit of Phill? I think you did, right?
I caught a little bit. I happened to have an opening day at the San Diego Yacht Club this Sunday. And so we did hear the roar from inside the clubhouse as everybody kind of went in to see what was going on.
Yeah.
But it was my understanding, a pretty epic ending there.
Yeah, absolutely. I mean, so he's just, for those who haven't read it in the news, right? He's the oldest player to ever win a championship, right?
How old?
So he's 50. He's turning 51 next month. Or maybe now, next month. So I think the oldest player before was 48, and this was like 50 years ago, right?
Wow.
And so here, Phill Mickelson's winning, and it's just an incredible story. He's, first of all, why we're talking about it on our podcast is he's our hometown hero, right? I mean, he's the,
absolutely.
He claims San Diego or Rancho Santa Fe actually as his, as his hometown, and which he's caught some heat for. We could talk about some tax planning here in California. He's been no fan of the tax code, and so he's caught some heat in the press from some people, and also a lot of support from others. But man, if you want to make a lot of money, Luke, if you walked in with $100,000 last weekend and put it on Phill, you'd have $20 million right now.
Well, I can tell you I didn't do that.
No, I don't think Phill did that, unfortunately.
So when I hear this story, what I think of is that I think I have almost a decade where I could really hit the driving range, and I could still be the PGA champion.
Yeah, that's right.
That's kind of what I'm feeling about it.
Exactly.
You got a big birthday coming up too. You've got over 10 years.
I got 10 years to win my PGA. I'll get it.
We'll just say.
Are you going to start practicing yet?
No.
We got time, right?
No.
But oh my gosh, I mean, it was just amazing to watch. I got to watch it. I was watching it with my wife. She was getting caught up into it, and she's like, "Oh man, I get it. The golf thing is so much fun, and it's a great sport you can play as you get into retirement too." So yeah, his fifth hole birdie shot from the sand. I mean, it hits it from the sand. The crowd goes wild,
right?
And it was interesting. He said to his brother, 3 weeks before, as the story goes, he said, "I'm going to win again." And he hasn't won for a while. I think it was 2013 was the last time. So it's been a long time, and he has this belief in himself.
That's good,
right? And just how much we know that matters. And his how did you do it? And he just says you gotta work,
right?
It just takes a little more hard work.
So as the perspective goes, like what I saw for the little brief periods that I did see of this match was all the energy in the crowd, the fact that the pandemic is really at close. And it makes me think of June 15th.
Yep.
I just got the letter from my gym that we don't have to wear masks on the 15th. They're going to use CDC guidelines. And all I can tell you, I was a social chair of 2 entities in school.
Yeah.
Right?
Right.
I like fun. I like to connect with people.
Yeah.
And I'm so excited that this is ending.
Yeah.
I am.
Yeah, and it's ended in South Carolina. Apparently, I mean, if you were watching that was incredible. And we have the Open here, right down the street, at Torrey Pines on June 17th. I think it starts. So, there's
that's when the Padres Open too.
Yeah,
June 17th, where they're going to sell out the whole stadium.
Sell out the whole stadium. So it's going to be a big weekend in San Diego coming up. I think
ready.
that's Father's Day weekend too.
It is.
All right, we should have some fun. Lots to choose from. So are we going to pay for those activities in our cryptocurrency? That's my segue. That was my shot at the segue. I don't know how. Wasn't any good, but
we're going to pay for half of them.
Let's we'll come back to the good news. I want to talk about this cryptocurrency fallout that we had and the new war with China, so it seems. So what happened?
So new war with China. So and we talked about it briefly a couple weeks ago with Elon. It just spoke about energy consumption. So there are just a lot of concerns about how much energy it's used to effectively mine different cryptocurrencies and how that works. And they're all very, very different. In addition, there was a lot of, government regulation talk about not being able to mine it, not being able to use it in China, and what that would mean to kind of near-term issues with different types of cryptocurrencies. So, it's a very nascent industry. I think a lot of people have a lot of interest in it because of these massive gains it's had, but a little understanding. And also within the system, there's a lot of leverage. And so when you do get these huge volatility spikes, there's a lot of forced selling that goes on. So I will say one thing that we could do to really add some value to this conversation about cryptocurrency beyond just simply that China didn't like it and Elon didn't like it is we could really talk about energy consumption and what it means for crypto. And so what I would say is that there's two forms of mining that are really talked about right now. One is called proof of work, which is for probably the most well-known cryptocurrency. And then there's this new modern mining called proof of stake. So proof of work is legitimately miners, which is just tons
Pickaxe, shovels.
Right, no, tons of servers.
Yes.
Tons of servers. And what they do is you have all these different miners, and they have to race to make a computation to solve a problem. So imagine however many miners have capacity, a computation hits the block, and all these miners chase after this computation to try to solve it. And when they solve it, they get awarded a cryptocurrency token.
Right.
So what that means is that there isn't just one person out there mining. There's tons of people mining the exact same trying to solve the same problem on the blockchain.
And it's people, right?
But
servers,
people, but
algorithms.
servers.
Yeah.
And so you have and as you can imagine, as prices move higher and there's more assets within the chain, there's more transactions. More transactions means more races means more competition, and more competitions mean more energy usage. And the penalty for proof of work is just simply a sunk cost. So it means that you are spending money on servers and energy and time, and you don't win the race.
And you're ripping them to shreds, by the way. Their half-life's pretty small, right?
And you don't win.
Yeah.
So the overall concern of proof of work is it just takes a lot of people doing the exact same thing to validate what's on chain. So let's move to what's happening today, which is called proof of stake, which is very different. So in this case, if you're a miner, you take some of your assets. In some tokens, it's 32 tokens, and you actually stake it on the blockchain. And as you stake it on the blockchain, if you have a very high value, you actually get chosen to be the validator, the single validator. Instead of having a race of many, you have one validator. So already you can just see way less energy usage and speed.
Yep.
And as you validate it and begin to post it on the block, you have other people within that format that attest it, which is a much less data computation process, much less energy intensive. And then as that validation is attested, then that transaction is put on the block.
And the reward is?
And the reward is effectively the same item. If your validation is attested, then you actually receive value. And the only way you're getting to even an option to do it instead of having a race is that you're taking your capital and you're putting at risk in the chain.
Yeah.
So those are two really different things. And I think when you hear some, I guess Elon or anybody really talk about energy inefficiency that's happening in particular currencies, I think you have to take a step back and realize that cryptocurrencies actually, it's turning into a multi-asset class. It's not just simply one token, one world. They're very, very different. And we're kind of seeing that happen right now as sort of some blockchains are moving into what is called DeFi and staking. And it gets really complex. I could talk about it for probably an hour here.
Right. I think a lot of people would like us to do that.
Yeah, you're probably right.
Yeah.
But the penalty for staking, if you do an incorrect transaction, they effectively take money away from you. So you give them money, you put in a pool.
Right.
Instead of just wasting your time on servers and whatnot, you've given them 32 tokens, a minimum, and they will actually take some of that back. So there's different reasons on why you're doing proof of work or to proof of stake, and there's different penalties. And generally speaking, moving from proof of work to proof of stake is it's much more efficient,
energy,
faster across the board in blockchain.
Transparent too.
Well, and all of them are very transparent.
Yeah.
I know a lot of people don't really understand that with blockchain. That's actually the beauty of blockchain is
Right.
it is infinitely transparent. But so if we just take a step back and think what really knocked cryptocurrencies on the head in the last 2 weeks, a lot of it was energy consumption. And if you're paying attention of really what's happening in blockchain, they're working really hard at energy consumption and speed of efficiency and validating the blockchain.
Okay, so then let's come back to what happened in China. So I mean, the headline was like China makes cryptocurrency, we'll just say, illegal.
Right. No more.
Right. And the market's kind of panicked. But that's not really what was happening, I understand, either.
Well, effectively, it's kind of like old news.
Yeah.
So they've been talking about this for years and just basically reiterating, we don't want you to do this, we don't want you to do this. The reality is that at this point, you're kind of slamming the barn door shut after the horse is out, right?
Yep. I mean, if you're long blockchain, cryptocurrency, DeFi, okay, so if you're long crypto, you kind of have to know that this stuff is going to happen, right? I mean, this is kind of a known, you
right.
know, of maybe not when, but we know that, the governments and national banks aren't going to go without a fight. They have standing armies protecting their fiat currency. So we all kind of know that in the future and are going to watch to see how that plays out. And the Monte Carlo analysis on how that goes and when is pretty wide. But I mean, if you're long cryptocurrency, you kind of know this to be the case. And so I think people kind of digest this short-term news, but it's like, did you not expect that to happen?
Right. And I think there's a quote that just that comes up when I think about fiat and crypto and really what people are betting on. And remember, some of the things we're going to talk about today is the focus of your investment. Are you looking 3 months in the future, 6 months, 12 months,
That's
18?
Right.
And when you think about cryptocurrency, effectively, a lot of people are betting against fiat. And what I would say is that the freight train to oblivion is not an express.
Yeah.
It's not an express train. That is something that even though we see these short-term moves, the reality is over a decade, that change in fiat and crypto, should that happen or not, that's going to happen over multiple years, not multiple weeks.
Oh, yes. Right. If not decades. I mean, I think of being long cryptocurrency is like, or blockchain is like being long the internet in the 90s, right? I mean, it's not an asset class where you're just like, I'm just going to invest in the internet.
Yeah.
Like, how do you do that?
Yeah.
Well, there's a lot of different options. Some of them lost a lot of money. Some of them made a lot of money, right? Some of them didn't exist when the internet was born, and it morphed into something different, and it continues to do that to this day. And yeah, we still have the postal service, the U.S. Postal Service, right? You can still get a stamp,
right?
And send something in the mail.
Right.
I mean, so there's obsolete things or obsolete things that technically we shouldn't do that we do. And so I think that the road is very long. But I think you had a really good advice to listeners and to folks that are maybe in the early to mid stages of their investing career. You should understand it and get to know it and just make that personal commitment to not turn on the blindfold.
Right.
Now, I think if you've lived on this planet for 6 or 7 decades and you're in your retirement years and enjoying, I had, talked to a client months ago who said, Dustin, I think I'm comfortable letting this opportunity pass me by. And I thought, just from a lifestyle perspective, it's not something that I need to do. There's the next generation. This is their thing. This is going to come up and it's going to be wild. And I really don't have to participate in this. It's like, no.
I like that perspective.
I do too, right? Because what are we trying to do, right?
Right.
I mean, inevitably, people look at their Coinbase wallet and they try to win, right? And they
Double down.
and they get sad when it's down, right? And it's like, well, what time period are you looking at?
Yeah.
Right? Did you look over a year, 5 years, 10 years? And people say, I'm waiting to get back to even. It's like, you're up 1,000%. What are you talking about waiting to get back to even? From what date, the highest point you've ever been? And I'm not just talking about cryptocurrency. I'm talking about everything, right? I mean, that's just how people perceive their investments on the stock that they love or the mutual fund or the index that they bought, and they do the same thing with crypto. So your time horizon and making sure you have a goal that is hopefully not tied to just money, right? Which is meaningless, whether it's a cryptocurrency or fiat, paper dollar. It's all meaningless unless you can do something with that money at some point, which you get to make decisions on and control. So we always want to bring the investing of why we're doing this and what we're trying to achieve.
There's even though most of the correlations within that entire asset class really go to one right now. There's lots of different investment options, and I think over time there will be separate performance traits. However,
that's a really important word that I always like to highlight the definition of correlation, and just how perfectly things move in tandem, right? So correlation of 1, things are moving in tandem. -1, they're moving opposite. 0, they're uncorrelated.
Yep.
And so as portfolio managers that put together different pieces of a puzzle to try to, or a portfolio to try to provide a certain objective and outcome of a portfolio, you don't want all of your eggs in one basket, so to speak. So when you have a correlation of 1, even though you're diversified, all of your eggs are in one basket.
That's right, they are. And so you kind of have to think of the big picture, and I think we've had some really big investment banks that have talked about how crypto is becoming its new asset class. I tend to agree with that. But for some reason, we throw out the window of how to properly allocate to this asset class. And what I would just really tell listeners is that cryptocurrency, unlike anything that I've really seen before in my investing career, really takes the escalator up and takes the elevator down, right? And so because of that nuance, it's really important to think about how it fits within the overall asset class, within your particular portfolio. And for those listening, definitely stay tuned here for another 10 minutes, and we're definitely going to talk about how asset allocation will help to build an asset allocation strategy for crypto into your normal portfolio today.
Yeah, absolutely. Absolutely. You know, we talk about the importance of diversification, which is, I like to point out, the #1 destroyer of wealth, right? The best way to make the most money is to take all your eggs and put them in one basket. It's just got to be the right one.
Yeah.
It consequently is the best way to lose all of your money too. Right? And so investors really have to determine what they're trying to achieve, because losing all of your money is probably not worth it. And so, you know, how much is enough, and that balance of fear and greed that everybody has, right? And what are you going to do? So
you're saying there's a chance.
Yeah, there's a chance. There's a chance. The wealthiest people on the planet got that way by putting all of their eggs in one basket, right? But for every one that made it that far, who knows how many millions went to zero.
That's a tough hurdle.
Yeah, we don't talk about the losers. People never talk about the losers in their portfolio, I've found. Over my entire career, I've never sat down and said, how's it going? Oh, great, I talk about these three stocks that I picked that were genius. So you only invest in 3 stocks? No, 30, but 27 of them I don't want to talk about. All right.
This is true.
So,
all right.
Okay, so bad news is good news. Good news is bad news. What the heck are you talking about?
So in the market, the market is just a basket of expectations.
Yes.
Right? We look forward and we start making expectations and we try to price those in. And so where we are today is that we've priced in a lot of strong expectations. Some of those expectations were that the economy would rip and have great news. And as that news would come out, say we had a really good economic development, what that meant is that we were going to have to stop feeding the economy with low interest rates and quantitative easing. Therefore, good news means that the Fed is potentially going to take away the cookie jar.
Oh, yeah.
Right? So that's bad news. So I get good news from the economy. I get bad news from policy perspective.
Right.
So in the last 2 weeks, we had a non-farm payroll number come out, and it came out at a huge miss. So the payrolls numbers for this year, January, February, March, and April, were 223,000, 536, 770, and then the expectation was 1 million of non-farm payrolls added back into the economy, and actually what we did was 266. It was a huge missed by about 800,000. So in that case, bad news is great news, right? The market's going to
keep the printing press rolling.
Keep it rolling. Keep it rolling. Bad news is good news. And what we saw was a big drawdown in the 10-year rate. We've talked about that now for this entire season. But we were kind of hitting, mid 1.7s, and now we're at mid 1.5. So we've had a 20 basis point decline. And what has happened from that is that all of the leadership that has really been gaining momentum this year, industrials, materials, consumer staples, and really has a lot of technology in the dust, have really started to reverse. Now you've started to see even I guess Kramer was out on TV the other day starting to pound the table on the old favorite 5 stocks once again because interest rates are lower and you can buy long duration assets. So just talk about a really challenging place to be a stock picker or an asset allocator when leadership seems to change every 2 weeks, right? Good news, bad news. So that's like from a really big perspective of like economic data, good news is bad news. Now let's think about let's think about what's really happening from a positioning perspective as we look at our portfolios. So 1 year ago, we were all told to stay at home. So if I was a online platform, I had the best month I've ever had in my career. Ever. Right. Everyone's at home either shopping or working or doing whatever. Move forward 12 months, and the way Wall Street works, I have to comp over that number. This is the best number I've ever done. So I was growing, I don't know, pick a number, 200%.
1,000%.
Right?
10,
now what am I going to grow? 20?
Right.
Which is just not good enough. It makes really, really difficult comps. And so we're seeing technology specifically, especially stay-at-home names, struggle as earnings season's going through, and they're having what's called difficult comps. Now, let's put our binoculars on. Let's think 12 months in the future. So let's say that I'm selling lumber or copper or any sort of staples. And let's say I'm a restaurant, for example, or anything that's doing a basic consumer service. How are my numbers going to look next year versus right now?
Well, first of all, right now they look amazing.
Right.
Because where were we a year ago?
Yeah, we were home. Right. So now you're comping over weak numbers. And then a year from now, you're going to have to do the exact same thing that tech just did.
Right. It's not good enough.
It's going to be really difficult. So we're in this really interesting transitory period where capital markets in general are really kind of floating around all-time highs. And yet underneath all of that, if you're paying attention, the leadership is just continually changing over and over and rotating, which really means if you're out there trying to flip your whole portfolio around and chase, you're picking things right at the top. Right. So it's really important to think about focal point of your investment. Are you thinking about investing for the next 3 months, 1 month, 6 months, 5 years? Really important to kind of move your focus on the portfolio to kind of a long-term strategy.
Well, and imagine if you had these multiple asset classes that you can overweight or underweight, right, versus being in or out, right? And that's kind of what we try to do when we're managing a portfolio. It's not betting it all on one sector, right, for the next 2 weeks, but you're able to take advantage of selling high and buying low when you rebalance a portfolio that has multiple asset classes and you go through cyclical periods of leadership change, right?
Yeah, and there's a lot of factors that go into building that portfolio, and some of those factors are legitimately holding on through really challenging times. Right? Yeah. So right now, a lot of the active managers out there that did great last year didn't decide to flip their whole portfolio over, rebuild their investment policy statement, and buy materials. They're still owning core growth stocks, and they're suffering through that right now, but that likely has a really strong time period, probably in the not too distant future, if we're kind of paying attention to what's going on now. So speaking about like really big numbers, I talked about stay-at-home stocks. So I wanted to just briefly talk about like how big some of these numbers are that are happening from the reopen and how distorted it's making all of the data that we use to kind of figure out what's going on in the market. So for example, corn prices are through the roof. Why? Right? Corn prices are they've grown substantially. Well, so China has the largest hog population in the world by a huge factor. So for example, China has about 406 million heads of hogs.
That the audience was shocked by that last statement. Right? They just all fell back in their chair right when you said that. So hopefully you guys are okay. So yes.
So 406, and just to give you like a breadth of the markets, 406 million in China, 151 million in EU, and 77 in the United States. So like it's off the charts, and that makes sense with how many people actually live in China. Well, to exacerbate that, in 2018 and 19, almost half of the population died due to swine flu. And so
of the hog population.
Of the hog population died because of swine flu. So why is that important? So through 19, 20, and 21, they've been bringing that population back up to 400 million, which requires a lot of feed. And China's been out buying substantial grain imports to feed that. So, for example, normally they're buying 3 to 4 million metric tons. They've been buying 12.
Wow.
Right? And as they've been doing that, the planter expectations here in the United States have actually remained flat to down. And so then our stocks are obviously low. If you go drive through the Midwest, there's grain elevators everywhere. They fill this with corn, and eventually those get sent somewhere overseas or used domestically. So we're looking at massive kind of one-time purchases to get fuel to effectively feed their industry and the distortion that makes on prices. So once again, you have to think, what's going to happen 2 years from now? how is that going to happen? They've obviously brought up their inventories in China in corn to feed. They're actually starting to use other items that they can use. So will we see just a straight line? Should we just take those 2 data points and straight line corn prices for the next 10 years? Probably not.
Right.
Probably not at all. Another one that I brought up was lumber prices. We kind of talked about that 2 weeks ago. This interesting data point here is that because of the price per 1,000 board feet right now, which is around $1,400, which used to be around $250, you can build 2 homes today with the same amount of lumber cost as what, 2 years ago, 5 years ago, you could build 12 homes.
Wow.
So the prices have gone up so
inflation.
much, right?
Yeah.
Prices have gone up so much that 5 years ago, you could build 12 homes with the same amount of lumber and only 2.
Wow.
Which is kind of nuts.
Yeah.
And so then that has lots to do with coronavirus shutdown, reopening, global supply chain, just all these things that we're really
tariffs
experiencing.
with Canada.
So what word comes up when I think about this? Transitory.
Yeah.
Right? Transitory has been a common feature we've heard from the Fed when they think about some of these massive data points in inflation. And I think there's a lot of value to really heeding that caution.
I mean, you've been educating me a lot over the last year on these cycles that go on globally, right? Including China and your research there. And I think it's something that investors, at least in the U.S., right, have absolutely kind of thrown international investing out of the window, right? Because for the last 10 years, it hasn't worked. Right? And we know that most businesses in the world reside outside of the U.S. Most publicly traded companies reside outside of the U.S. Most of the population is outside. I mean, we know there's a world outside of the U.S., right? Yet, due to a select few really high-performing, powerful companies that have mega cap valuations, right, that we have, over the last 10 years, pick a U.S. index, and it's trounced any international index for the most part that you would pick. You go back a decade earlier, and it was the exact opposite, right? And so you go, and I think it's just important for people to look at these time horizons and to think about what is their time horizon for their portfolio and their asset allocation. Are we looking for the next 3 months, 3 years, 5, 10, 15? What are we trying to achieve? But I mean, if you look at the 2000s, 2010, the S&P 500 lost money, right? Where if you look internationally, like in China, composite index, you doubled over a time when the S&P was down. The next 10 years, what would you expect to happen? So now we're going to talk about the next 10 years and what do you expect to happen, right? So it's at least worthy of the conversation to understand how international also, I think, fits into a portfolio allocation as we move forward.
I would agree with that.
And there's good news and bad news, and it's like good news or bad news for you. Hey, let's do a little fun exercise. I'm putting you on the spot. I hate it when you do that to me, so I figure maybe I'll do it to Luke.
Great. Hopefully these aren't pop
You tell me
culture
whether
questions.
this is good news or bad news. We're going to play a little segment feature called Good News or Bad News with Luke Jacobson. All right. I wish we could have some, like, some game show music. Dun, dun, dun. All right, Luke. The personal savings rate in the U.S. in the first quarter of 2021 was 21%. That's January through March of this year. U.S. personal savings rate, 21%, which is just taking after-tax savings divided by after-tax income. So after-tax savings, 21%. In the U.S., first quarter of 2001, 20 years ago, the savings rate was 5% for that same quarter, coming out of a recession. Good news or bad news?
I'd say that's great news.
Yeah.
Personally, I would say that's that particular event, and that's why I think this summer, if you're trying to book a hotel or a flight, it's really challenging because people are flush with cash.
They are.
Not to
Luke.
Not to mention, what it really
They're
means.
not spending it.
They're not spending it yet, but what that actually means is that capital is in the banking system, and so our banks are extremely well capitalized versus what we might have experienced in other, say 5, 10 years ago.
Okay, so let me see if you can connect these two dots.
Okay.
'Cause there's some
So you want me to pay
disconnect for me
attention,
here.
right?
So, yes, people are saving at an alarming rate in the first quarter, yet in the first 4 months of 2021. Okay? So, through April 30, 59% of U.S. households made a large purchase. Okay? Which is the highest we've seen in the last 5 years. This what includes a large purchase is furniture, home repairs, and automobiles. So they've saved more money than we've ever saved, and we're spending more money on large purchases.
That's interesting.
And so we've seen this different way of, where is our money going, right? I mean, it's certainly that we've had some subsidies, we've had more income, right, for a lot of U.S. households coming from the form of support with coronavirus relief, businesses getting that. So less has been going to rent. Certainly less has been going to automobiles and gas and some of these other things, but freed up a big part of U.S. budgets where they're able to save and now buying. And so good news or bad news on the 59% of large purchases?
I'm going to go with bad news on this. And the bad news is that the indicator specifically, to me, what it says is that I'm going to spend it on my big ticket purchases because I have nothing else to spend it on. And the bad news is that if you think your business is really killing it right now, in 9 months from now, when the rest of the economy opens, there's going to be tremendous competition for dollars versus simply cars, home improvement, and furniture.
Yeah.
So that would be the bad news only if you're that business owner.
Both of these, right, and everything that you just said, right, comes back to inflation in my eyes and where we're going. And so we've seen really high periods of inflation before. If you go back to, 70s and 80s, you had multiple years, consumer price index up in 1978, up 9%, right? 79, the next year, up 13.
Ouch.
The following year in 80, up 12.5. The next year in 81, up 9.
Ouch.
Oh my gosh, this inflation. And what did we do? We moved the federal funds rate up to 18%.
Ouch.
And you got a 15% mortgage when you buy your house, right? Ouch. So there's some ouch.
That's tough.
Potential if we have this inflation go too much and what we know is interest rates. And when you talk about good news is bad news, look, we want the good news. We want the healthy economy, okay? And what's going to happen is we're going to have inflation. We've talked about this ad nauseum. It's going to happen for a little bit, so make sure that you're not just sitting on dollars. And that is going to have interest rates go up, right? Whether the market does it or the Fed does it, it's not all at the Fed. The market can do that, right? China can do that. Europe can do that. And the high prices cure high prices, like you've always said. Yep. Interest rates are going to start going up. We know some things that are going to happen in your portfolio. We just saw it this year. And if you don't know, you should find out, because we know we kind of look to the future. Do you not think interest rates will go up? Do you not think taxes will go up?
Taxes.
What are we going to do? Right? Are we going to pretend like we don't know this information? I don't know when, but we know this information. We know kind of how the impact is going to ripple through certain people's asset allocation.
Right.
We should probably pay attention, have a plan for how we address that.
I think one of the best questions we got this week was, instead of will taxes go higher, it was, how high do you think they're going to go?
And we're running over on that, but I did want to, today, gosh, this is why we have to just do this show. We come up with a lot of the material. It should just be the day of. But today, right, Republicans came back with kind of their what do you call it?
Their stimulus plan. Their
infrastructure, their counter offer, right? And so, what's took out $600 billion, it's right below $1 trillion. So pretty close. We're getting there. I got to tell you, I politically, I don't find myself really affiliated aggressively with either party. Kind of in the middle somewhere. But it is kind of nice just to see some civil negotiating going on as we look to get this deal done. It's kind of nice. It's not so hot these days, and I like that. But there seems to be a lot of kind of posturing to maybe that corporate tax rate going from 21 to maybe 25 is kind of, I think, where the popular belief is, looking at both sides. So that would be a pretty good win as far as I think, our U.S. corporations are concerned and investors. All right, we're almost done. One more good news, bad news, just because it was such a big part of your talk. China had 12 million births in 2020, which is 3 times that of the U.S., which had 3.6. Good news or bad news?
I'm going to go with that's bad news. That sounds like a really low number. So you said it was what was the multiple of the U.S.?
So 3 points. So We did 3.6. China did 12.
Yeah, that 3.6. I'm gonna do the math in my head 4 times now. So we're what, 350 million? They're 2 billion.
Mm-hmm.
That's not very many. That would say bad news for their long-term status, right?
Mm-hmm.
You need to have for your basically for your payment system, retirees, to take care of your older people as they go. You need to be backfilling with lots of births. So I'd say that really brings a huge challenge for China long-term.
Long-term.
The
Yep.
demographics there are not in their favor with that.
Yeah.
That's a big number to remember. 350 million versus 2 billion.
Right.
That's a number that I think a lot of people don't have in their head, but that's why China matters so much right now.
Yeah. Yeah. Okay. Good. All right, everybody. So went a little bit over. We're going to bring back some tax asset location planning, I think, in the next episode. It's too important for us to gloss over. So let's make sure we key that up for episode 13. That's going to be on June 10th. Please don't miss it. We're going to have a wonderful episode for you and let you know what we have in store for this summer. So hopefully everybody has a very safe, happy Memorial Day weekend. We'll see you all on June 10th. I'm Dustin Tenbrook.
I'm Luke Jacobson. Thanks for tuning in.